Hi everyone and welcome back to Finance with JCL. This show is aimed at beginner and intermediate level investors, and I'd like to warmly welcome you to today's episode, which is around investing objectives. Why should you set them and what sort of things you should be considering? So the objective for today is to explain why goal setting is important in the context of investing. And to support that, I will share some considerations that I believe you should be taking into account whilst you set these goals. So I guess the starting is probably why set an objective for investing? So I think that this stops you playing in the market. It means you're more disciplined. Think, I'll just chuck a tenner at that share, buy a couple of Tesla shares. Oh, Apple looks good. Yeah, they might be brilliant companies, even the price may be good. But actually, how is that investment helping your goal? What are you trying to achieve by risking your capital in this way? Because let's not forget, investing does entail capital risk. Now, some investments are safer than others, and there's an element of unpredictability. But if you're risking your money for something and you need a certain amount of money in the future, you should have a goal, and you can plan your purchases to support that goal. And if you have got these investment goals, you can generate a plan. So you're kind of going about your investing in a bit more methodical way rather than a scattergun approach. If you do have this investing plan, you should periodically measure it so you can track progress. We'll come on to examples in a minute to bring this to life. So, for example, you might say, I want £1 million by the age of 65. That could be your sole investment objective. So if you need £1 million by 65, you could work backwards. Let's say you're 30. You've got 35 years in which to make £1 million, and you could work out how much you need to save each year over those 35 years and what rate of return you need in order to hit that money. And then when you actually go and buy a stock, you can think, right, does it meet the criteria to hit that objective? And if not, you don't buy it, even if it is an exciting stock. And that's why an objective can be so powerful, because it means you're only investing in things that meet a sort of minimum level of return or suitability. So perhaps an easier objective example might be just want to protect your money against inflation. So let's say inflation's a bit lower now, but it could be long-term 2%, 3%. So if you put your money in the bank and you got no interest on it, your money would be losing because the cost of goods in the economy is going up by 3% every year. So your objective might simply to be, I want to earn at least 3% a year in order that inflation doesn't erode the value of the money. My hard-earned money, I've put blood, sweat and tears into, I want to make sure inflation doesn't destroy that. For 30, 40 years, inflation really can eat away at the value of your savings. Another example might be I want a pension pot of £1 million, and based on the 4% rule, which is a general investing principle that if you have a pot of money and you withdraw 4% of it in income, over the long term, the actual pot should stay the same size because the companies in there are making sufficient returns to hit that 4%. So if you had a pension pot of £1 million, you could take £40,000 per year income and probably maintain your £1 million capital sum. That could be a goal. You might just think, do you know what? I fancy a bit of passive income. I want £500 a month coming in 10 years' time that I don't have to work for, that my money generates that for me. You may wish to retire early. You may retire at 52. I think that's the dream, isn't it? But it's going to be quite hard to do. Some more examples, you may think, do you know what, I just want to get more than I get in my bank. The bank rates have been very low since sort of 2008, so you don't get much interest in current accounts. So you might think, I don't want this measly 0.5% or even less interest. I want to get, 2, 3, 4, 5% a year because I can't get that through my bank account at the moment. So you may invest on that basis. You might think, do you know what, the stock market returns about 7% a year on average over the long term. So I want 7% a year for the next 30, 40 years just to grow my money in a conservative way. Yeah, that's pretty cool. I'm going to drop a link in because that's one of my main investment objectives. So you'll see a link above here if you want to find out more. Quite a common one, I think, is some people like to maintain a sufficient investment size so that they can maintain their existing income and lifestyle, but once they retire, so they don't have that employment income coming in. So that's always a good one to look at. And then they might just say, do you know what, in 20 years' time, I want a 30 grand pot, because with that 30,000, I'm going to pay off my child's student fees, hypothetically, that they may incur at that time. I guess a similar one could be, I want a pot of money that would surprise them within 30 years' time when they buy their first house. So all of these things are fantastic objectives. And I wouldn't say you just need to have one. You may want to keep it simple and just have one. But some of them could be put in together. So you may want to retire early, and you may also want to have a sufficient investment size to maintain income and lifestyle once you retire. Or you may want to protect your money against inflation, as well as have a pot of money to pay student fees in the future. So do kind of mix and match them up. And these are just a sample I've come up with rather quickly that sort of jump into my head when I'm thinking about investment objectives. But there will be others, so don't just feel that you have to look at this list here. So I hope that's been useful in terms of some example objectives to give you an idea of what we're discussing. So some considerations whilst you're looking at setting your goals. Have a look at your age now and think about that. If you're 48 but you want to retire early at 52, that might be tricky. If you're 20, that might be perhaps more achievable. Have a look at pensions. So do you have some pensions that you can draw into your planning? And with regards to state pension, that age that you can take is increasing in lots of countries. I'm assuming by the time I get to that age, it's going to be 70 before I can take it. My working assumption is actually there won't be a state pension at age 70, because I think it's just become unaffordable in the long term. So think about that. And things like care fees. So do you want to have to sell your house to pay for care fees potentially as you get older? Or do you want to have some money so you can secure your house as an inheritance for your children? And do you want to make some investments for your children? So these aren't just goals for yourself. They could be family or goals for your children. About taxes on inheritance. So you might want to have a massive investment aim, but if you've got a big pile of money when you die and you get taxed on half of it, then that's not so hot. So think about how that fits into your plan. And then think about that tax efficient investment. So investing into a pension is tax efficient in the UK because the government gives you tax relief, so you always get some free additional money effectively invested into your pensions. And we've also got something in the UK called ISAs, individual savings accounts. So you can invest £20,000 a year in stocks and shares, for example, in these ISAs. And any gains or withdrawals are completely tax-free. So you want to maximise these kind of mechanisms. Look at your debts. So you might want to think about investing, but do you have some debts to clear off first? Are those interest rates quite high? Because it may be worth paying those sorts of things off first. And if you click on my budgeting video, have a look at that one. That will give you some tips for setting that budget. And then finally, consider lifetime event. So do you know you're planning to propose shortly, and in 2 years' time you have to pay for a wedding? Are you saving up for your first house? So therefore you might not want something that might fluctuate because you're going to need that deposit money in 2 years' time. So you might look at bonds rather than technology shares, for example. So these are all the things at the minimum that I believe you should consider, and there are more. This is not an exhaustive list, this is just your starter for 10. So the point I'm trying to get across here is that although we all go through a lot of similar things, so similar life events like getting married or buying a house, retiring, etc., your circumstances are very much unique to you and your family unit. So don't just copy what other people are doing. It's okay to listen to other people's suggestions, but just because someone else has had success with a particular approach, it doesn't mean that it's right for you. So do make an individual kind of twist on your planning and take professional advice if you are struggling with that, because it's sort of life planning is part of this. So you can set your investment goals and it's going to affect you in the long term. So make sure you're giving the right amount of attention and diligence. So in terms of how you actually goal set, I think you need to plan on a joint and even on a single basis as appropriate. So you may have some personal investments, also family ones as well, such as sharing a mortgage together. So that should be taken into your consideration. I think your objectives need to dovetail with your general life plan. So as kind of mentioned, if you're going for some exciting stuff like buying a house, getting married, make sure that kind of is factored into your investment plan. And if you're having children, that will reduce the amount of free money you've got to invest. So factor that into your long-term plan. And in fact, you may wish to invest on their behalf. So the objectives should be smart as well. So they should be very specific, so you know exactly what you're aiming for. For example, I want £1 million. They should be measurable, so you should be able to track your progress on a regular basis. They must be achievable, so don't set £1 billion target. That's not really achievable for pretty much everyone. It's going to be something you can generally achieve, so you keep at it. And also, got to be relevant. So there's no point setting things that aren't really relevant for your lifestyle and your life plan. And then finally, they should be sort of time bound. So if you want to set a target of £1 million, you should then say by when, and that allows you to work out how much you need to invest each month, what kind of returns you need to hit the target. So do, as you're making your various investment goals and your life plan, review all the considerations that we've discussed and more. So that's not an exhaustive list. And I urge you to take perhaps some professional advice if you're a bit unsure about what you can do, what the options are, because there are many different ways to invest. And I do also recommend logic testing with your friends and family, because everyone's kind of done this to some extent. They might not have written down a plan formally, but people may have an idea of, I want to retire at this age, or I want to achieve a certain salary level, or I want to save a certain amount. And do try and learn from your peers, your family, different people, and take it into consideration. Don't copy, but do review their ideas, because some of them may help you. So the benefits of all this, from the investing perspective, if you've got some goals set, you can say, right, I need a square bracket 6% return when I want to buy shares. So if I'm buying shares, if the thing I'm buying won't make a 6% return, then I don't buy it, regardless of how exciting it is or how much I like it. So I should use that kind of proposed return as what's called the discount rate when you're valuing a company. And I do have an example of that with Apple, where I've used a discount rate and spoken through evaluation. And then also when you're investing, use a margin of safety, because you might want a 6% return to hit your objective, but we can all make mistakes in our calculations, and we want to have some wiggle room there. So if you get your discount rate right, put a margin of safety in, you're buying things for less than they're worth, then it's less likely to go wrong and you're more likely to hit your objective. And this is something that I do, and I strongly recommend that you do it if you understand how to work through that process. And in terms of your non-investing financial decisions, with all this planning, you'll be able to look at long-term decisions like your mortgage, so whether you want to overpay your mortgage or what size of mortgage you can get in the future. It will help you with your monthly budgeting, to have sort of discipline and control over your household finances. And again, the logic testing with the friends and family is great here, because you might actually be able to get the ideas from them for your other financial areas, but also to share what you've learned, what you're doing with them, because you may be able to help people as well. So, in summary, I believe that you should set objectives before you start investing, most importantly because you're more likely to become more disciplined and successful in doing so. All of this activity supports or enables your life plan, so it kind of dovetails pretty nicely. But do also bear in mind your unique circumstances when going through the considerations, because what's right for one person may not necessarily be right for you. So thanks so much, guys, for joining me today. I really appreciate you hitting the like button if you're watching this on YouTube, so that it becomes more prominent in the YouTube algorithm. And again, if you could hit the subscription button and the notification bell, you will receive word when I upload my next video. And if you want to hear more, that's the way to go about it. So thanks for joining me, and I'll see you next time.